the basic premise here that we're going to talk about is that investors overestimate the impact of the Fed, the Federal Reserve, and other central banks on markets, and underestimate market structure.
So market structure literally means who are the market participants and what are the behaviors that they're engaged in, right? And you can think about the simplest examples of market structure that have occurred over the course of my career, which, spanning 30 years now. This would include things like the ending of the traditional specialist structure on the New York Stock Exchange or on the American Exchange, the collapse of the multi-regional exchanges. You used to have the Pacific Exchange out here that traded options on a regular basis, or was one of the primary repositories of options. You had the introduction of decimalization, right? You've had the introduction of high frequency trading. You've had the collapse in interest rates that influences not just the underlying behavior of market participants in terms of how they value a discounted stream of future cash flows, which is certainly an impact, but is a little bit less clean than I think people would generally think about. But more important than that, I would actually suggest the loss of that kind of high yield or relatively high reasonable return. 2000, you could have gotten 5.5% to 6% from a US 10-year treasury. Today, you're looking at 1.5%, which has forced people into the market for all sorts of alternative yield structures, things like selling call options or underwriting put options, to generate additional yield on their portfolio and obtain the income that they feel they're being deprived of as they approach retirement. So that behavior is ultimately what I'm referring to when I talk about market structure, the behavior of the internal participants.
Got it. A big one you didn't mention was index funds and the move to passive investing. Is that another one there?
I had a sneaking suspicion we were going to bring that one up in future discussion. But yes, to me, that is actually the single most important structural change that has occurred. In 1996, if you had looked at the market share of passive investment strategies, it would have been somewhere in the neighborhood of 2%. Today, that number is 2% of the US market capitalization. Today, that number is somewhere in the 44% range. And that's a combination of passive index mutual funds, ETFs, what are referred to as total return swaps, futures, all sorts of indexing strategies that would also include things like commingled investment trusts, CITs, which are basically non-registered mutual funds that operate at slightly lower costs and are often offered in things like 401ks and IRAs, et cetera. So those have exploded in size in a manner that almost nothing else can really compare, in my analysis, at least.